Good morning from the San Francisco Bay Area. I'm Vijay Rajendran, head of global corporate growth at 500 Startups, one of the most active venture capital firms in the world. It's a pleasure to have everyone here for today's conversation on impact investing by CVCs with our panel of experts. Before talking about today's main theme, I wanted to briefly talk about our upcoming VC Unlocked Silicon Valley online program, a fully virtual version of 500's flagship investor education program held in collaboration with the Stanford Center for Professional Development. This 4-week program is focused on emerging leaders who want to shape the future of the venture industry. Now, during our interactive online sessions, you'll work closely with Stanford University faculty and 500's leadership to hone your investment strategy with hard-won insights from our instructors. Tap into a world-class network of global VCs and angel investors. If you are interested, the first step in the admissions process is to have a colleague or a peer submit a nomination on your behalf. Please check out our webpage, which you'll see here, and we'll be posting in the chat in just a few moments. The program will be held from October 4th to 29th, and very importantly, the early application and diversity scholarship deadline is Friday, June 18th. So on that note, welcome everybody today, and I'm excited to welcome you all to this panel and why we are talking about CVC in impact investing with a panel of experts that couldn't be better positioned to talk about this topic. Now, why are we talking about this? Well, last year, about 20% of all venture capital was corporate venture investment. Today, as sustainable and impact investing continues to gain momentum, it's clear that corporate venture capital investing in impact opportunities will continue to grow. Now, our goal at 500 Startups and the focus of our ecosystems team is to support entrepreneurship around the world. And on the heels of 500 Startups corporate innovation and corporate venture capital research, we'd like to convene this group to discuss why and how corporates are pursuing this growing field of corporate impact investing. So on that note, I'd love to invite our panel here to introduce themselves, starting with Claudine.
Hi, everybody, and thanks to everyone for joining us. Really excited for the conversation today with this great group. I am Claudine Emiot, and I am based in San Francisco, where I lead the Salesforce Ventures Impact Fund. We launched our first corporate venture impact fund in 2017, a $50 million fund, and followed that up building on the success of Fund 1 with a $100 million Fund 2 late last year in 2020. We invest with the same core thesis as Salesforce Ventures. So we are a strategic investor looking to identify and invest in high growth enterprise software companies. We're searching for companies that could build integrations with our platform, But on top of that, our team is also looking for companies with demonstrable social and environmental impact in areas like education, sustainability, financial inclusion, health, and other categories that tie back to our core product areas that also have an impact lens.
Ryan, over to you.
Sure. Thanks, Vijay. Thanks to the entire 500 team for hosting this. It's good to see my friends Claudine, Ken, and Moses all together here on a call. My name is Ryan McPherson. I lead impact investing for Autodesk and Autodesk Foundation. If you're not familiar with Autodesk, it's a market-leading 3D design and make software company based out in the Bay Area. I myself am actually up in Boston, Massachusetts. Our customers are the types of innovators that are really designing and making the world that we see around us. And so that's from the things like the consumer products that we get to enjoy every day to the buildings that we're sitting in right now, really doing some just really innovative and remarkable things using Autodesk tools as an enablement. And so our impact investing practice actually follows a similar type of model as the designing and making that our customers are doing within our industries. And that's to invest in early stage entrepreneurs that are using design and engineering to lead those industries towards more sustainable and equitable outcomes. That's when what we call our 3 impact opportunity areas of energy, materials, health and resilience, and work and prosperity. And we're generally investing at the seed through Series B level, following the deal terms set from lead investors. And like many of my friends here on the phone call, really thinking about where we can be additional beyond just capital, where the lion's share of our value comes from. And that's for Autodesk in the form of technology and talent. So thanks for hosting here. Looking forward to the convo.
Ken, over to you.
Thanks, Vijay. Nice to see everybody. I'm Ken Gustafson with Merck. For our global colleagues here today, Merck operates as MSD outside of the United States and Canada. And at Merck, we have a $50 million impact investing venture fund, which I manage. And it is primarily a fund of funds, although we do have direct investments as well. And our thematic focus is on expanding healthcare products and services for underserved populations in the developing world and emerging markets. So we're looking at things like physical infrastructure, hospitals, clinics, diagnostic centers, financial inclusion tools like health insurance, life insurance, and then ancillary things like digital and diagnostic tools that will advance healthcare and also are adjacent from a therapeutic standpoint to areas that the company is actively involved with. So we're getting the primary social impact of reaching more people with those products and services. We are experiencing some very solid financial returns with exits from the portfolio, and where appropriate, looking to generate business opportunities through portfolio companies, not dissimilar from what my colleagues have already shared. Good to be here today.
Awesome, thank you, Ken. Again, my name is Vijay Rajendran. I lead the global corporate growth team here at 500. And my team and I work with some of the leading corporations in the world to help them identify, partner with startups, and also invest or figure out their new growth areas that they want to build. And last but not least, we're also joined by Moses.
Hello, and thank you, Vijay, Janelle, and the whole 500 Startups team for the opportunity. I'm Moses Choi, and I'm a director in the Sustainable Finance Group at RBC Capital Markets, a leading global investment bank. The Sustainable Finance Group collaborates across industries and products to support clients as they integrate environmental, social, and governance factors into their respective businesses. In doing so, we seek to unlock ESG and impact opportunities to finance operations, growth, and transition. We structure instruments such as green, social, and sustainability bonds. And last year, we brought the first woman-led special purpose acquisition company, SPAC, to market. As part of our overall strategy called the Climate Blueprint, we have committed to a $500 billion 2025 goal to mobilize sustainable finance opportunities. Additionally, and I think what's relevant for our conversation today is we work across RBC to advance purpose, innovation, and inclusive growth. Through RBC Ventures, we incubate and invest in companies and funds to advance the strategic ambition of RBC. The approach is to invest and partner with startups and to provide strategic resources to scale. And for direct deals, we look at opportunities in the $3 to $5 million range from C to A. We've also done acqui-hires, and also we've done fund investments, and we can talk more about that. I'd be also remiss just briefly not to mention that we have RBC's Tech for Nature program, which is run through our foundation, but is a multi-year catalytic funding effort to advance innovation through technology to solve the greatest climate challenges of today and tomorrow. So thank you very much. And those are just a few highlights to orient where I sit. And back over to you, Vijay.
Amazing. Thank you all. This is a rare opportunity where we get to bring together people who are kind of cutting edge and really, truly thought leaders. That's not an exaggeration, but also deep practitioners. And the overlap in that Venn diagram is sometimes not very big. So it's exciting to have you all here. I'd love to tee things up for us today by zeroing in on the question of what trends are driving the evolution to this field of corporate impact investing, and how did we get here? And maybe this is a good question for Moses and Ryan to tee up.
Yeah. Thanks, Vijay. So I guess just to orient the audience a little bit, what we've seen is over the last couple of decades, companies increasingly integrate ESG factors to drive sustainable business. The numbers are all, you can see them in really any kind of news article you read about this space. 13,000 companies report on their ESG performance. 99% of CEOs consider sustainability as important to their future business. And I think when we think about sustainability, it is about incorporating these material factors to drive business performance and competitive advantage. And I think what's important to think through a little bit is, evidence from the public market suggests that companies that integrate sustainability factors lead to long-term outperformance, lower cost of capital, and lower stock volatility. In fact, RBC Capital Markets has produced through equity research that suggests that companies that are sustainability leaders actually see a valuation premium in public markets. Interestingly, I think also we're seeing the quantum of capital in this space continues to grow in public markets and private markets. Sustainable investing represents $30 trillion of assets that are professionally managed. And of course, we know the trends of Gen Z and millennials coming into this space. And so within that context, in the last decade, we've seen increasing appetite for private markets investors who are developing impact-oriented strategies with an intention to drive and generate positive social and/or environmental impact alongside risk-adjusted financial return. What began initially as kind of a niche market now has grown, whereby the largest asset managers in the world, like Blackstone and KKR, all have sort of deliberate impact strategies. And there's estimates that this space is somewhere in the tune of 700 billion. So emerging in this context is this group, and really delighted to be joined by some colleagues here today, are companies that are saying, what can we do through the balance sheet of our firm to drive innovation, drive sustainability and impact. And by marrying the logic of CVC and impact investing, we're seeing this emergence of this field of corporate investors that are seeking to generate financial return, strategic value and impact. And so I think the last thing I'll just highlight is, companies have a lot to do both on the asset side and liability side. And where I sit, as we see the opportunity for companies to raise things like green bonds and use those proceeds to invest in assets that drive impact, we see that there's an immense amount of opportunity. So maybe with that, I guess, Ryan, love to hear your thoughts on this space as well.
I think you just really teed it up really, really well there, Moses. I mean, across the sort of capital markets, what we're seeing in the regulatory environment and what's being demanded by employees and consumers, there's just an increasing amount of pressure on companies to be able to walk the walk on sustainability. And I think you're seeing it from our firms and many of our competitive firms and firms within the broader ecosystem. Sustainability is becoming a non-negotiable, and how companies are walking the walk on that. I think an interesting thread to follow is where that manifests and how the capital is being allocated, where investments are going. So for us, we're speaking mostly about innovation and early stage venture, and of course, that's the sort of world in which 500 Startups is quite the leader. But as we started having these conversations, the four of us actually put our brains together and did a little bit of a market scan on what we were seeing from our peers within the space, and that accumulated in a co-authoring an SSIR, Stanford Social Innovation Review article just back in February. So Vijay, if you don't mind sharing that around, I'm sure folks might be able to poke and prod and ask us some questions related to it. But from that analysis, what we found is that over the last 5 years, corporates that are investing in innovation with impact intentionality has grown over 50% at a compounded annual growth rate. And in cumulative, there's about $8 billion in commitments that are public. Of course, that could be sort of an order of magnitude larger, depending on how you define this, but with just the strict definition of impact intentionality, thinking about those three levers of impact, strategic value, and financial returns. There's some nuance to what that looks like depending on the structure, and we can get into some of that together here. But those are originating from the ventures arm, from the foundations and philanthropy arms, from the balance sheet and corporate development arms, from off-balance sheet single LP or multiple LP vehicles. But I think one of the interesting characteristics that ties it all together is that there's this hypothesis that with intentionality across all three levers of impact, strategic value, and financial returns, that these investors with a corporate context believe that they can capture more value across each. So I think that's what you're seeing emerging right now, and is certainly underpinning a lot of how we're seeing the marketplace evolve.
And I think some of the data that you all surfaced in your article is, about half of the funding is coming from the corporate balance sheet in particular. So companies are putting like real dollars and deciding this is a priority, carving it off from the balance sheet. This is certainly significant there, as well as like through foundation and other commitments. So that's super important to see.
Yeah, you're just sort of seeing this convergence there, Vijay, right? This sort of greater coupling of corporate strategy and impact intent. And I think you're going to continue to see that going forward. And how that sort of convergence happens between each of these parts of the business will be interesting to keep up a pulse on.
So I'm sure some people are wondering right now, how do I actually do this? And I think the most effective way is to kind of like tell the story of why and how did you develop your corporate impact investing strategies. So I'd love to start with Claudine to kind of tell us about that journey.
Sure, absolutely. So Salesforce, founded over 20 years ago, totally disrupted software at the time, but also started to disrupt very early on with its business, the idea that business could be a force for social good and social change, and pioneered a new corporate philanthropy strategy called the 1-1-1 model, which it shared with thousands of other companies around the world. Similarly, Salesforce has built a really strong muscle as one of the very best and most active CVCs globally. And so you had these building blocks of a really strong corporate venture practice and a really strong mission built into the DNA of the company from the beginning, that we can, again, do good while doing business. And it took, it didn't take long for executives a few years ago at the very highest level to realize there's an opportunity to marry those two components of a mission, and then strong capabilities in software investing. And like Ryan and Moses have said, just bring some intentionality to the idea of doing impact investing. And thus the Impact Fund was born. And we launched, as I noted in my intro, a $50 million fund initially, targeting those spaces within our ecosystem where we saw a strong opportunity to bring our core expertise to bear. So investing in ed tech companies, workforce development solutions, financial inclusion solutions, all areas that tie back to our platform, where we could add value as a large SaaS company ourselves, and also, again, bringing mission into the equation. So we, like all the others on this chat here, are looking to solve for three things with every investment. We're looking for financial return, we're looking for strategic integration with our platform, and we're looking for demonstrable impact. And it's been a really fun journey to see how that has grown and evolved over time, and to see others come into the space too, which is what our group has been really focused on the last couple of years, which is, to tell the story so we can help others figure out how to do it. And there are lots of different ways to skin the cat. And I think we all represent a slightly, kind of different approach. And I think that's important too. There's not just one way to do this.
Absolutely. There's definitely not just one way to do this. And perhaps next, Ryan, I'd love to hear from you in terms of how you developed your investing strategy.
Today, our impact investing work sits within the broader corporate impact strategy that we're sort of alluding to before there, VJ, where you're just seeing this sort of intentionality of corporate strategy being married with the impact intent. And, but that was a journey, and we're continuing along that journey. Our first impact investment actually originated through the foundation back in 2017, using a fund structure, an LP position. That sort of spurred from a culture of thinking about innovation as a way to be able to solve some of the world's most pressing challenges, natural technology orientation from the company, and how we can support hardware and the design and make of new solutions. Thinking about how to be able to orient our long-term, sort of thinking as an equity holder to each of these innovations that was being supported through the foundation, sort of created the fertile ground for starting to think about this back in 2017. And so since then, sort of increasingly have started to move that back towards center, following that same journey that we're talking about. So now we have a dedicated impact invest practice using an off-balance sheet donor advised fund, but also are increasingly thinking about the intentions of our M&A investments on our balance sheet by bringing in impact covenants as a part of those deal terms. So we sort of incubated it within the philanthropic arm, and then as that value started to prove out over time across those three levers of impact return, financial return, and strategic relevance, continued to move that back towards center.
Thank you. And Ken, I know you have a unique origin story as well. It's also distinct.
Yeah, for us, similar in a lot of ways to my colleagues, but our entrance into impact investing was very much as an offshoot, as a way to complement our long and strong history doing philanthropy for social impact through product donations, medicine donations, and financial grant programs and things like that. But then with the increasing overlay of environmental, social, and governance considerations, we started looking at impact investing as a way to ratchet in financial return in a sustainable way to a similar level of social impact. And so we are very active in the philanthropic space and will continue to be. But as we can add in impact investing, it's another facet that we can reach a broader set of underserved populations for healthcare products and services. For a long time, we've had a very active core venture fund that operates in another part of the company. And so we complement with skills and expertise between that fund and our social impact fund. And it's just a way to raise the bar in terms of the type of impact we get, the returns that we get, and how we have a more complete approach. And I think that from an external standpoint, to echo Moses' point earlier, that as we look at other external partners, they want to see that a company is using all the muscles that we have, whether they're philanthropic to get social impact, or increasingly impact investing. What's fun for me, thinking of Claudine's comment of when they started, we couldn't have a panel discussion like this 10 years ago. It would be sparsely attended and there wouldn't be that much to say. But now we're having a great panel, and I'm just watching this flow. There's another one of comments coming in of people who are interested in participating in the dialogue, which is great.
Yeah, this is definitely an exciting and growing field. It's powerful to see not just this trend, but also I think general consciousness that everyone has of how real this opportunity is. And I think that's a great sort of like segue in terms of like the visibility that you have. So Ken, while I have you, what role and what like visibility what role does leadership play to support your objectives, and what visibility do they want it to have in the organization?
Yeah, so we have our impact investing committee that's made up of really senior members from across the company. We have people from finance, from line management, from different functional parts of the company. So that gives us a very nice cross section of different areas of interest and expertise within the company at a high enough level that it gives us that enterprise view for what's going on. And we work with that committee both to review and approve new investments, and then to look at how the portfolio is progressing. And then as we do that, it generates opportunities for us to share more internally with other parts of the company, so that people are aware that we have this impact investing arm that's doing what it does. And then externally, we increasingly look for opportunities to include our messaging around impact investing through panels like this. Or last year, for example, we were very delighted to be included in Fortune's Change the World list as one of the companies that are doing things to have intentional, mutually reinforcing social and business value. So we're looking for ways both to contribute to the dialogue and also to benefit from what other people can contribute to the dialogue.
Absolutely. And Ryan, what role does leadership play in supporting your objectives?
I love sort of Ken's anecdote there in terms of his investment committee being made up of senior leaders across the business, because I do think if you're going to walk the walk and try to realize some of this untapped value, it really requires that sort of connective tissue across the business. You know, for us, we're set up in a way where our board of directors are the senior executives of the company, our CEO and entire C-suite. And I do believe that that's one of the strongest mechanisms that we can have these types of conversations around how impact innovations will be moving our industries towards these more sustainable and equitable outcomes, and vice versa, right? So I think that, you know, from that same Stanford Social Innovation Review article, executive buy-in and leadership is a very critical characteristic here, and one that sort of ties a lot of our work together.
And I'm sure one of the things you're all communicating frequently is, you know, the impact versus strategic return, and then risk versus return, and how to find the right balance there. Claudine, you know, based on how you're set up, you know, how are you approaching, you know, that those two dimensions, and how are you communicating it internally?
It's a really great question, and it's one that, as you point out, Vijay, we're constantly grappling with every company that we're looking at every stage of diligence too. And I think it's important to note up front that we're not a concessionary fund. So we are striving, like our colleagues on the core venture side, for market rate returns. And we use the same deal memo processes. We have the same investment committee that our colleagues on the core ventures team do. And I think that that's really important, and just setting the expectation that we are aiming to achieve market rate returns with our investments. But we're also looking for that strategic piece and impact. And so admittedly, sometimes bringing those three lenses to bear is challenging. And we are not necessarily going to maximize for all three in any given investment. And so we're looking at all three together in conjunction, and looking to see if we feel comfortable about the balance of them all. When it comes to impact, I also think it's important that we would never invest in a company where we as a team don't feel very strong conviction about the impact. And I know we can talk a little bit more about methodologies later on in the conversation, but we are rigorous in our diligence approach to investigate the impact and to build an impact thesis into our deal memo. And again, if we come away from that process not feeling really strong about it, then that's reason enough to walk away. And then I'll just touch on the strategic side too. You know, it's important for us to justify an investment, of course, that, you know, we can see a potential strategic opportunity with our platform that benefits Salesforce down the road. But just as important, we want to make sure that there's a strategic tie so that we can add value back to the company, right? Many times we're in a conversation from the get-go because of the potential strategic value we bring along with the impact lens. And so we want to make sure that what we can offer is as a strategic partner is real. And therefore we want to make sure that there is something tangible that we can progress, with the company post-investment.
That's terrific. And Ryan, I see you shaking your head. How are you continuing to communicate impact versus strategic return, and then risk versus return itself?
I just love this as a topic. Maybe this is something that VC Unlocked for 500 Startups event over at Stanford can really dive deep on, because I do think it warrants a whole lot of time. But at the highest of levels, I do think that when you're having intentions across these three levers, knowing what's first order or subordinated is important. And for Autodesk, where we have those multiple vehicles of either using our balance sheet or using a philanthropic fund to do so, the intentions, the first order and the subordinated order can change. So, for example, our philanthropic fund, of course, is being held accountable to impact outcomes, specifically around climate change and mitigating carbon dioxide emissions. We recently just made an investment that went public this morning in a company that's a direct air capture company that's removing carbon dioxide out of the atmosphere. Very interesting from a sort of what the impact could be at scale, where Autodesk can bring its additionality from both the technology and design for manufacturability perspective, but also as a purchaser of high quality offsets in the voluntary market. But if you think about marking that to market on our balance sheet on a quarterly basis, it doesn't really make sense, right? This is more of a long-term play and where we're seeing our customers and our industries moving, and it would be doing a disservice to the entrepreneur to be sort of putting different types of pressures on it. So that's just an example on how we can think about an impact first mentality through that investment to think long-term about value creation.
No, that's awesome. And I'm going to turn to some audience questions in about 10 minutes, but I know there was one about, is reducing CO2 emissions an example of impact? And clearly that is. And then I do want to turn, Ken, to you, and in terms of like how, for your $50 million fund, like how you're communicating, like what is impact and versus strategic in terms of return, and the types of risk return objectives or trade-offs you have.
Yeah, so I think we've all talked about similar versions of the triple bottom line of social impact, financial return, and strategic or enterprise business value. Somebody recently was asking about our investing, kind of insistently saying, well, are you impact first or are you financial return first? And our answer was, well, neither or both. Because we are looking for social impact coupled with a financial return. And to Claudine's point, we're not looking to be catalytic or concessionary in any way with the returns that we're seeking. We're trying to maximize our returns and are looking for market rate returns, but also trying to get strong social impact. And so we don't want to sacrifice one for the other. One observation I would make, though, is, and this is also one of the challenges, I think, in the space, at least from a healthcare standpoint, and that is when you're talking about healthcare products and services, we have a bunch of different ways that you could measure impact. So if you have a diagnostic center, it's people coming in to be diagnosed. If you have a new pharmaceutical or vaccine product, it's the number of people that are taking that product. If you have a financial inclusion tool on a smartphone, it might be the number of people that are using it. And the scale of reach of those different types of products and services can be very different. So it's not necessarily a fair comparison to say, well, we reached 100 people through this new platform, but we only treated 50 people with this new product. So we have to keep that in mind. And what we usually end up doing is distilling it all down to the number of people reached through products and services for the underserved populations, because we have so many different facets of impact that we can look at.
That's awesome. Thank you. And I'll let Moses talk a little bit about, from the RBC perspective, how you think about those pieces of the equation. Impact, strategic, risk, and return.
Yeah, no, thank you. And so, we're RBC's 150 plus year old firm. And so, ESG is core to what we do as a franchise in order to, maintain our license to operate and contribute to broad stakeholders. Within the ventures team specifically, which is a different part of the organization from where I sit, we are still very much focused on looking at the future of financial services. And so as it relates to this continuum, if you will, of financial and strategic, I think really we are, as a ventures team, on the ventures team, they are very much focused on strategic opportunities and thesis-driven opportunities. And with that, it is undoubtedly clear that, the future consumer is going to care about and does and will continue to care about ESG and sustainability. And it's also very apparent that the future consumer in the US in particular is going to be more diverse. And those are two secular trends we know. And so things that the ventures team is doing currently, one is an external investment through a fund. So I don't know if I mentioned at the top, but we're an LP in Plexo Capital, which is led by Lo Tony. And through Plexo, we are further our efforts to become more strategic around diversity and inclusion. This points to some of the research that we've looked at, which suggests that, from Harvard Business School, that diversity improves venture capital performance at the individual portfolio company level, as well as the portfolio level on the fund. But despite that, we know that the numbers don't bode well for diversity with respect to investment managers. And so the firm invested a couple of years ago in Plexo. We also do internal incubation. And so one of our teams that was actually brought on board through an acqui-hire is currently in the process of developing an app to help consumers measure, reduce, and offset their carbon footprint. And they're going through beta testing on that app at the moment. And so I think from an impact perspective, we don't have a dedicated fund per se, but it's more about the strategic lens and thinking through trends and then identifying opportunities related to it.
Well, that's awesome. I could continue this conversation because I have way more questions for you guys, but I actually want to step aside for a second, make sure we have enough time to get to some of our audience questions, which are really exciting as they're coming through. I guess one that's for the broader panel to begin with is for folks that are investing into funds, and a couple of us are doing that here. What challenges do you see among the smaller emerging impact funds? Is there transparency that you have to go through to get to the underlying portfolio companies? How are those funds telling their story really well about the firms they're investing? How they evaluate and do their own metrics and measurement? I thought that was a really neat question. I'd love to get the perspective of folks that are making LP investments here. Ken, please.
Yeah, Vijay, I can give a comment on it. So if we look at our fund portfolio, which you can find on our corporate responsibility report website, but the funds that we're invested in range in size from 30 million to about 700 million. So they're a big range of sizes, but regardless of the size, we have a framework that we work from when we're evaluating certain key criteria for an investment that include things like how will they be measuring impact? Usually the funds will be referring to some sort of objective standard, which we like to see. Usually they will be transparent and public about publishing and reporting on the impact of their portfolio companies. So is it objective? Is it public? The way that they do that is very important. And also, as the field matures, we're also seeing a lot of fund managers are now on their second, third, fourth fund. And so you have that track record of seeing how did they do in the past? Can they be consistent with that in the future in terms of impact measurement and reporting? And that helps a lot too. And I think we'll continue to mature.
And then Ken, while I have you, there was another audience question about Merck and its role in emerging and developing markets. Does that include particular regions for emphasis? And in particular, are you active in the Middle East as one of the attendees wanted to know?
Yeah, our fund investments cover primarily Sub-Saharan Africa and Southern Asia. Nothing directly in the Middle East, although we do have a fund that's headquartered in the Middle East. But most of the opportunity, at least historically, through the funds has been in Sub-Saharan Africa and Southern Asia. We recently just closed our first Latin America investment, which is a direct investment into a breast cancer screening company for underserved populations.
That's awesome. No, thanks for sharing that example. I guess one other question that's bubbling up from the attendees is, what impact metrics are being used in quantifying impact investments? Are you looking at SDGs? Are you looking at GIINs and so on? So if anyone can share some examples of that, that would be super helpful.
I'm happy to jump in and share our approach. So yes, to both of those, we align with both the SDGs, and we also rely on the GEN's IRIS metrics. We also use another framework, the Impact Management Project's 5 dimensions of impact, which many impact investors, most I'd wager actually at this point, are coalescing around as a common meta architecture for understanding impact that doesn't get into the nitty gritty of metrics, but it sort of has everybody coalesce around the same way to think about impacts from a what is the problem, who is the population impacted, how is the solution going to have impact from both a breadth and depth standpoint, what are the risks of the solution happening or not happening, etc. And I find that this is a really useful way to approach impact during the diligence portion of our investigation, and also then sets us up well to weave in metrics collection, where we primarily rely on the IRIS Plus metrics on an annual basis. And we also, though, that's sort of a top-down approach using external standards and metrics that our industry largely agrees upon, but we also really want to be able to surface any specific metrics that are particular to the company and their business model. And so our process takes into account those as well.
Oh, that's amazing. And while I have you, Claudine, the another question that is kind of on the table here is, like, how do you add value to the portfolio afterwards, and kind of bring resources of the company into the picture, if you could comment on that.
Absolutely. And I think this is, again, really important to at least have a firm thesis on kind of going into the investment, because it's going to be important for the relationship with the company post-investment, obviously. And it may be, really core to why the company wanted to bring you into the cap table from the first place. So it's important to have a plan. When we think about adding value, I think about it in 2 broad buckets. One is on that strategic integration piece. So let's say we're investing in an ed tech company. Presumably this company could potentially build an integration with our education cloud, whether it's K-12 or higher ed, and then that's something that we can take to market together. And so from an investor perspective, we're working with our portfolio development colleagues as well as our colleagues who are specifically, on the go-to-market and product side for the relevant cloud where this solution would tie in, to help shepherd them along through that process of understanding what it takes to partner with Salesforce, building the integration, and we're sort of playing puppeteer in the background to make sure that things are moving along on that front. And a lot of that is really based on the company's timeline. They have obviously a lot of priorities on their list, and we are understanding that we may not stack rank as number one, but we're there and ready when they are. Then the other area is, more general. We obviously have just a ton of expertise in-house as Salesforce. And so we have a stable of advisors that we can unleash on a company when they're ready. And we have people who can speak to everything from pricing to sales enablement to marketing to DEI and more. In a one-on-one conversation, we also are increasingly offering more systematic programming, webinars and such that companies can sign up for. And then, we as an impact fund team are also, rolling up our sleeves and partnering with our companies on impact measurement, always looking to keep that ball moving forward, and help them uncover what metrics they should be measuring and the best ways to do so.
Oh, thank you. We're getting a number of questions around, do you like this region of the world or this emerging market and so forth, including one regarding Southeast Asia, in case anyone has some experiences that they can share publicly. And the topic this is raising is, how does the region you're investing in affect your ticket size and your general sort of portfolio construction? So I don't know if anyone has come into that situation and can share the implications for how they think about ticket size and the portfolio.
I'll just make one general comment for others to build on, and that is, it's probably true to say that the broader the geography, the bigger the pipeline of investable opportunities is, and that would make the fund size potentially be larger. I mean, the fund could decide to be smaller, but if you wanted to have a larger fund, you would probably need to have a larger geography. Another consideration would be how focused the fund is. So in our case, we're looking at either exclusively or really primarily healthcare focused funds when we look at a fund. And so that obviously narrows the field of the pipeline of investable opportunities if you're just looking at healthcare. Oftentimes, though, you can see an impact fund that might cover a lot of different areas of impact, which can be fine for some investors. It could just be a general ESG fund that has a little environmental, a little bit of housing, a little bit of banking. And in that case, that also increases the opportunity to have both a broader diversification and potentially a larger fund size because you have more investment opportunities.
Absolutely. Any thoughts in terms of deviating or broadening your definition of what the ticket size should be?
We're thinking about that quite a bit on our side, and it's not just ticket size; it's also financial structure and whether or not equity is the right type of injection of capital for where the business is in its own life cycle. Especially if you want to be able to support sort of local entrepreneurs working on local issues, to be able to support local capacity building and economic mobility. And the best that we've done thus far is really sort of rely on the experts that are in region that are thinking about this in a really deep and sophisticated way, and helping to empower those intermediaries. I think assuming that here in Boston, Massachusetts, I'm going to go drop a large check size into a company that's in its early stages where perhaps equity is not the right type of structure is just sort of the wrong type of thinking. That's not necessarily going to empower the company to grow and scale. So I do think that sort of collaborative ecosystem-based approach, which I think a lot of our funds take, is important to be able to make sure that we have that type of global reach and meet people where they are.
Yeah, I think that's very exciting because certainly in traditional venture, where things are pretty baked and funds occupy a very specific niche, their check size, what stage and so forth can be very restricting sometimes in terms of the types of deals they want to pursue. But given where we are at this still very explosive and early stage for impact investing from corporate funds, there's a lot more flexibility and just openness, like you said, to thinking is equity the right call here? I'm going to do one last audience question, then give us some time to wrap up and close on time. So one question is, to know about programs within funds that also promote minority social enterprise and diverse or minority founders to reduce the funding gaps that exist. And certainly we're all familiar with just how vast that funding gap is. So I'd love for folks to talk more about how they're thinking about casting more attention to underrepresented or underestimated groups of founders. Perhaps Moses, you talked a little bit about your investment in Plexo, if you'd like to start.
Yeah, and I can also broaden it a little bit. We have seen in the last year in particular a growing number of corporates who are using balance sheet capital to invest on the asset side, either through funds or through other, let's say, intermediaries. There are even instruments out in the US called like community development financial institutions, like CDFIs, and a lot of corporates are allocating to CDFIs as an illustrative example. Within kind of venture specifically, for us, again, I think it really had to do with we knew that there was a funding gap in this space for underrepresented women and minority GPs in venture capital. B, this was very much a strategic endeavor for RBC because D&I is not something that we care about from an ethos and values perspective, but it's also strategic for our clients and for future opportunities. And so, yeah, we made an initial allocation a couple of years ago, and we are actively looking at a number of other funds. There's one in Canada that I know the team is looking at, and there's another in the US that's focused on the Latinx community that we are looking at as well. And I would just say, look, I think a lot of companies, whether it be, PayPal, I know Salesforce has done work in this space as well. And I know Merck and the one initiative that Ken Frazier led with Ginny Rometty from IBM, and I'm sure Autodesk has other stuff on the space as well. All corporates are really trying to think about the vector of D&I and how to become more strategic about it. So maybe I'll pass it on to someone else who'd like to talk about what they're doing on the D&I front.
I'm happy to jump in, and I just love the fact that we are representing so many different viewpoints and strategies here, that there's a fund of fund strategy, because while we don't do that at Salesforce, it's so important to empower check writers from diverse backgrounds to write checks to diverse entrepreneurs. So kudos to my colleagues here who are investing in funds like Plexo Capital and others. Because we take a direct investment approach, that's where our strategy is, of course, focused. And last year, Salesforce Ventures committed to investing $100 million in Black and underrepresented minority founders out of the Salesforce Ventures portfolio, with the goal of increasing our investments and overall number by 3x within the next 3 years. And that's one strategy in the venture ecosystem. But also, as Ryan noted, there are other tools outside of venture, and we think about just the broader ecosystem of supporting diverse entrepreneurs. And some may not be ready for venture, some may never be ready for venture. We have another tool in our toolkit at Salesforce through our Salesforce Essentials product team, which is focused on the smallest and earliest of businesses. And last year, they enabled disbursement of $5 million in grants to diverse-owned small businesses, actually through one of our ventures companies called Eureka that supports digitally native small businesses with services and tech support. So, we recognize that it requires a multi-pronged approach at the fund level, at the venture level, and also I think philanthropic funding too.
That's awesome. Thank you. So in the last few minutes we have left, one of the things that people are asking in the chat, in the Q&A from the audience is, how can we apply to your programs? How can we get in touch and reach out to your organizations? So I guess beginning with you, Claudine, how should people get in touch with Salesforce?
You can email us. I can drop in a team email handle into the chat here, and feel free to send a note. We're happy to always take a look at a deck and see if it makes sense to continue the conversation from there.
Ryan, how would you like people to get in touch with you?
Pulling on the same DEI thread that was just top of mind and a part of the discussion, this year Autodesk has opened up the top of the funnel to try to check some of our own biases within our networks and where we have natural exposure. And so the best way to reach out to myself and to our team is the same way that every organization now reaches out to myself and to our team, which is through our website. And that's at autodesk.org. You can just work your way through to a discovery forum that just expresses some interest and starts the dialogue where we can start to think about where those connections can get made.
Very cool. And Ken, how should emerging fund managers or folks that are building something awesome and want to connect with you and Merck, how should they get in touch?
Yeah, I would say first, take a look at our website, which is the top level, the URL is msdresponsibility.com, where you can find a profile of our impact investing approach in our portfolio and see what types of things we're already invested in. And that'll give people an idea if they're on the right path. And then you can find me on LinkedIn and send me a note and we can take it from there.
And Moses, how should people get in touch with you?
Yeah, I think for now, I think LinkedIn is probably best. And obviously check out RBC Ventures, his website, but LinkedIn is probably good for now.
Very good, thank you. And you know, I'd like to thank Ryan McPherson, Claudine Emiot, Ken Gustafson, and Moses Choi for joining us today. This has been a superb conversation. I really appreciate their insights and most importantly, the powerful work that they're doing as investors. On that note, we want to convene a global community of all stripes of venture investors, corporates, family offices, angels, and others making direct investments. And so if we have the page up, for those that may not be familiar, 500 Startups launched a brand new investor Slack community called 500 VC in 2020. And our goal is to connect our global investor community through networking, deal flow, and insights on this platform. And today we have over 1,000 vetted investors representing over 40 countries. So if you are active, accredited, and would like to join, please visit 500.vc to submit your profile. So on that note, again, thanks everyone for joining today. We had over 320 people at one point, I believe, on this call, which, you know, to an earlier point, it's just a data point and evidence that, you know, we've come a long way in terms of interest, awareness, and activity in the corporate impact space. So appreciate everyone's enthusiasm and participation today. Be well and be safe.
Thank you, Vijay. Bye, everybody.
Thank you.
Thank you, everyone.
Thanks all. Take care. Thanks, Vijay.